So why have you got AIM stocks and UK small caps that are so unloved? Well, for AIM, there has been a clear issue with the amount of inheritance tax money coming out of the market. And it's quite frankly, it's got to ludicrous. I mean, people selling now are totally bonkers.
On today's episode of the Professional Investor Podcast, brought to you by Fundamental Asset Management, we're diving into the AIM market, where share prices have slumped, but company trading performance often tells a very different story. We're joined by Chris Boxall, Portfolio Manager at Fundamental Asset Management, who discusses why, despite strong results, compelling dividends, often above 5%, and some of the best value he's seen in many, many years, some investors are still selling at levels that might, in hindsight, look completely bonkers. We touch on bargains appearing across the UK small caps and explore whether this disconnect is an opportunity waiting for those with patience.
Okay, thank you, Chris, for joining us today.
Yeah, great to be here. Morning, the sun's shining, so it's good news.
Ab ab
Excellent.
Absolutely. And today we're going to be talking about AIM and the specifically companies' trading performance, and trying to delve a bit into how companies are performing in terms of their fundamentals. I suppose compared to how they're performing in terms of their share price, and perhaps a little bit about why there's a disconnect there. So I'm sort of keen for those who aren't so aware, and obviously many of our listeners are, but for those who aren't aware, there's obviously the AIM market has been a disappointing place for some time now in terms of share price. Uh, and yet you scratch beneath the surface and there appears to be a lot more to the story than that. So I don't know if um you have any insight in that at all, whether you want to sort of share that with
Yeah,
our
yeah,
listeners.
look, I think you've hit the nail on the head. The stock market, the AIM market, the AIM index, the FTSE AIM All Share Index has been dramatically underperforming now the main market, the UK main market for some time. UK main market had a great year last year, and you'd be forgiven for thinking that oh, these AIM companies are doing terribly. They're absolutely awful. And we've spoken about this before, but it's just continuing all the time. And there's this disconnect between the performance of the companies and the market. You could say, okay, put it the other way, the market's always a barometer for the future. So maybe the future trading prospects of these businesses don't look that great. But it's hard to feel that that's the answer. Looking at how they have been trading, look at how they're investing, looking how what the cash they're generating, and important the dividends they're chucking out. I mean, it's now unprecedented the sort of dividend yield you can pick up from AIM companies. So they're trading pretty well. They've their trading does not reflect at all, what the stock market is saying. The stock market is, as I said, the AIM index is obviously totally disconnected, and within the AIM index as well, there is a disconnect because you've had the AIM index driven by some quite large, and one in particular, very large resource company, which is involved in gold mining. And clearly, gold's flavor of the year, flavor of the end of last year, and anything gold related has been booming. So that's actually been that's even been helping the AIM index. Without those stocks, more, what you'd say, general AIM trading companies, AIM software companies, technology companies, anything involved in online retail, really normal operating businesses on AIM have seen their even more dramatic underperformance, which is, highly surprising relative to the trading updates they've been putting out, and indeed their results, which look pretty good.
Before we jump into some of that in more detail, please, Chris, because it sounds like topics that need further explanation, further investigation. The the disconnect as such it is large based on what you're saying, and based on just a sort of a cursory glance at the market anyway, because it's been going on for so long now. But what do you put that down to in the main, or are there multiple factors?
Well, from a general perspective, you've had an era of more elevated interest rates. I mean, they're not that elevated by
Mm,
historical standards by any stretch. They're not really that elevated, but they're more elevated than they have been. They're due to be coming down. They haven't come down as fast as some people anticipated. You've got the UK house building sector, which is still in the doldrums. There's a lot of AIM companies with exposure to that. The whole economy is exposed to that. So this has also resulted in a sort of drag for the index. But then again, some main market stocks are flying. So why have you got AIM stocks and UK small caps that are so unloved? Well, for AIM, there has been a clear issue with the amount of inheritance tax money coming out of the market. And it's quite frankly, it's got to ludicrous. I mean, people selling now are totally bonkers. I mean, if you're selling out of AIM now, you're potentially missing out on a great run. You can afford to wait a little while. I appreciate IHT planning is generally for more elderly, but if you should only be in investments anyway, if you've got multiple years time horizon.
mm.
But if you've got a few years, you're picking up 4, 5, even 10% dividend yields on these AIM stocks. They're pretty secure dividend yields as well, underpinned by cash. So in my opinion, you've got all this IHT money that's been flooding out to these, shall I say, somewhat questionable private IHT schemes. No, I won't say somewhat, very questionable IHT schemes, which miraculously never go down in value, which they're an investment miracle, a real fairy tale. But
I think if I
real
may,
mark.
yeah, sorry,
Yeah,
the Financial Times did an article only the other day, sort of questioning one of these funds, but I think the question could be levied at an awful lot of them with regards to the valuations always going up as well, wasn't there? So, sorry, apologies, carry on, but I thought that was
yeah, no,
an
the
interesting.
valuation's always gone up. I mean, they're incredible. They're absolutely miracle. There must be, it's financial engineering par excellence, isn't it? I mean, they
Certainly.
never ever go down, even during pandemics, but they only go up a tiny bit consistently. And surprise, surprise, the pricing of their net asset value is determined by their own board. Well, a load of independence there. Anyway, we won't dwell any more on that, but you've got a lot of money coming out of AIM to these, shall we say, more questionable schemes. I dread to think if tax rules change, if the IHT rules attack those as well, wow, you're going to have a massive mis-selling scandal. But
Mm.
you're having a lot of money flowing out of AIM, and it's become, it's crazy. We thought it had stopped. Clearly, you got the changing tax rules on the 6th of April, but now you're selling really decent businesses at ridiculously cheap valuations. So I would implore anybody, if you're ever looking for a buying opportunity, this is quite frankly a once in a decade buying opportunity to buy small companies at bargain basements valuations. I mean, the value on offer is phenomenal. And as I say, you can prepare to wait a bit. If you're picking up 5% dividend yield, it's ahead of inflation. It's ahead of what you're getting in the bank. All right, you're taking on some capital risk, but bear in mind where the valuations are sitting. I would say there's really good opportunity for major upside. The other reason for the disconnect and is also that AIM's got a lot of technology and software companies, and you have seen a big sell-off in software all around the AI fears. Again, if you look at the actual details, though, some of AIM's software companies, subscription-based software companies, are in pretty good shape. They've been investing in AI a lot. Conceivably, they're going to be beneficiaries of the growth, the greater interest in AI. So, I wouldn't write them off, which appears to be the case that has been the case for investors. And again, you with the share price falling back, you're seeing some hitherto growth stocks now appearing as sort of value plays with giving you a 4% dividend yield.
Mm. And in terms of, let's say, investing 101, when you're looking as a professional investor who's managing portfolios at a company and you're making a decision based on the fundamentals, you've gone over this in the past, but I think it's always worth repeating. I'm right in saying you're really more interested in the long run. You're interested in how the company's uh, basic setup is in terms of their fundamentals, their
Yeah.
sales book, their growth, their debt, and so forth.
Yeah.
is really far more important in the long run than the share price, because the share price will, in theory, take care of itself. Is that a fairer
Yeah,
sort of
spot on.
fair
Spot on.
analysis?
Unfortunately, yeah, it's absolutely, absolutely. So the share price will ultimately take care of itself. What you're happening, it hasn't been taking care of itself
Sure,
lately
that's the
for
frustration.
reasons that we've explained. The liquidity reason that flows out. You're having more sellers than buyers. It's a market. It's a stock market. And the
Mm,
stock market needs more buyers than sellers. Well, you've had more sellers. You've had the IHT sellers. The buyers have been few and far between. But ironically, the clever buyers, particularly US private equity groups or European private equity groups, have been snapping up these AIM companies. Even the most ordinary looking AIM companies are being snapped up. Last week we had, or last month, sorry, we had Kitwave, which is a distributed wholesale business. It's hardly the most thrilling of sectors, tiny margin, mature market, seemingly. Well, private equity like the look at it at current levels. The management clearly hatched a deal and off it went. I mean, that was a
mm,
4 or 5% yield stock. Hadn't been on the stock market that long. So you're even having the less jazzy looking sectors that are attracting interest. But yeah, you look at the fundamentals. You look at where the growth's coming from. Is there growth coming through? Is the top line growing organically, not just by acquisitions? Is the balance sheet in good shape? Is there a lot of cash, real cash being generated? Another thing that I don't think AIM companies are doing themselves, and this applies to the stock market in general, is all the stupid adjusting of numbers going on. I mean, proper statutory accounts seem to be disregarded entirely, and companies are now presenting sort of headline figures which are extremely massaged, shall we say, and full of adjustments. You've got to look in the detail, but even looking at the detail of companies, they're trading well, and they're using those clever ones. They're also using their cash to make you know acquisitions as well to help drive growth. So yeah, the fundamentals are key, and the share price will react. Um, but yeah, there are just so many opportunities out there. I mean, our risk is our book is looking so cheap. You haven't really got to look elsewhere. You just focus on your own book of stocks and think, well, why would I sell out here? I'm an idiot because these things are just ridiculously cheap. So personally, from my own personal trading perspective, I'm a buyer at these levels.
mm,
Iran war notwithstanding, because I can see that on a 3, 5, 2, no, even next year time horizon, I can see these pop higher. And the Iran conflict isn't going to go on, hopefully, for too long. It's a wishful thinking, but
sure.
yeah, hopefully that
Sure,
it
sure.
looks like that's going to be the case.
Yeah. And in terms of the Iran conflict, obviously it it sort of came when it appeared to be as an arbitrary decision based on Donald Trump in the White House. So it's something which you can't entirely account for, that it happened, and in theory it could end tomorrow. It's unlikely to, but it hopefully isn't going to run for too much longer, especially if it proves unpopular in America, if it is based on this arbitrary decision by effectively one person. But does that mean that the market can then start to recover relatively quickly afterwards, or is there a risk of things getting far worse, with the oil crisis going from bad to worse and fuel prices going up increasingly, or is
I mean, high
what's your
high
take on that?
energy prices are never good, are they?
Yeah,
They're not
yeah,
they're good for an economy. There's an inflationary impact clearly that's coming in. Interest rates now, any interest rates cuts in the UK are off the table. Conceivably, there might be interest rate rises
mm,
in the future. Not sure when, but they've sort of notionally called that. So higher energy costs are always an issue, which is ridiculous for a country like ours, which
mm,
could be self-sufficient almost.
mm,
We've got plenty of renewable focus. We've got actually decent oil and gas opportunities. Crikey, there isn't probably even a call to bring back coal, isn't it? Rather than be
mm.
dependent on other countries. So yeah, energy prices are an issue. However, how does that in reality impacts a lot of our portfolio companies? I would say relatively little. We're not in resources stocks where you might get a positive swing. So that's a in certain resources stock, not in any oil and gas stock where you might have had a pop. So we don't own those. On the negative side, yes, input pressures affect people using lots of energy. We've got we've got a few companies exposed to that. But again, so much bad news is in the price. And take one of our biggest stocks, one of AIM's biggest stocks, Jet2, the
Mm,
airline. I mean, everybody's freaking out, thinking, "Oh, it's going to be terrible for airlines." The headlines say you're not going to be able to get fuel. I mean, Jet2, if you look at it, this is public information. It's hedged its fuel out to, I think, 81% of its fuel's hedged out to 2027.
mm,
It doesn't fly much to the Middle East. Apparently, everybody's changing their holiday arrangements now to fly to Spain and
Spain, yeah,
European, Portugal,
yeah.
North Africa, European destinations. Well, that's Jet2's hotspot. It's got a new fleet of planes which are more fuel efficient. It's it's opening new bases. Got the Gatwick coming in as well. So it's selling more seats. It could get a boost from this. Well, the shares are off 45% off highs now.
Mm,
Um, it's got heaps of cash. It's got mountains of cash. It's in a net cash position. It's got a wonderful business model, and most importantly, never forget this: it's well liked by its traveling customers. That's
mm,
the key. At the end of the day, if you've got a good proposition and you're well liked, well, all other matters equal, that is key. And Jet2 seems to be very well liked, very highly regarded. It always, scores well on the ratings, but nobody likes the stock. In the
mm,
meantime, it's buying back shares as fast as it can, buying back
mm,
its own shares. I mean, we had this last time with Jet2. I look back on it in the pandemic. The shares got absolutely smashed, and it
mm,
was an incredible time to buy. It was a magnificent buying opportunity. I feel we're soon reaching the point again with this stock, given how it's fallen, and it's a lot better business than it was, you know, in the pandemic era.
mm.
So yeah, that's just a small example of the potential out there.
And in terms of, you've mentioned a few times now the sort of the buying opportunity that there is right now. You also mentioned that people selling now might be badly mistaken if they were to do so. I think you used the word bonkers, but and I I'm wondering whether there is an argument, and I'm interested to hear your take on it, on getting out of stocks now with the hope of being able to then time it right so that when you get to the actual bottom of the market, you then get back into it to then maximize your return. In reality, is that sort of thing even feasible, or is timing it almost just impossible to
Um,
to
we
get that
probably wouldn't be
right?
having this podcast if I knew how to time the market.
I thought you might
I
say
mean,
that.
time, it's time in the market, not timing the market, as they
Mm,
say. And it's very hard to time a market, even harder in the small cap world. And some people look at their charts and their support levels and momentum and all this gubbins. I think yes, I'm being a bit harsh there because there are grounds for looking at that. However, in small micro caps, and you've got different reasons around flows. You're not getting the sort of trends that will help you. Or trend analysis is a bit harder. But yeah, there are grounds for looking for support. But yeah, timing the market is very, very tough. And before you know it, in the small cap world, it's off. You've missed it because you could, just as they sell off quickly, you get some momentum going and these things can start moving again because the liquidity or the illiquidity of the shares then works in the favor of the holders. Um, because you just can't get this. There aren't sellers and only buyers at the moment. We're the other way around. We've got a lot of sellers. But yeah, I mean, I just think it's bonkers carrying out at these levels. If the rest of the world is looking at a cheap market to buy into, despite all the problems our country has got,
mm.
I would say UK small caps, and for UK small caps, 70-80% of it is AIM. Well, it's a great place to look. Yeah,
Yeah.
but ironically, our population is bailing out now. I mean, that's an indictment, really, of our investing process. We bail out when it's the time to buy in. We buy in when it's the time to bail out. I mean, it's just ludicrous.
So in a nutshell, because timing is so difficult, if you're in there, or if you're not in there, get in there. You don't know that this is the bottom, but you're by the time it's the bottom, it's probably long past the bottom because the market can move up so quickly, especially with AIM. And then if you are in there, you've taken the pain. You might as well keep 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 your nerve for when the turnaround comes. Again, you will be the one to benefit from it rather than waiting to get in a illiquid market, which is going to be very tough to actually get into at that moment that you're wanting to
Yeah,
ride the
exactly.
curve the right way. Yeah. Okay.
You're not going to get in the bottom. Forget about
Mm,
it. Assuming that the shares are going to lose 5, 10% their value. Just think like that way. However, in mitigation, you're going to think, well, if I hold it, for a while, I'm going to get 5% dividend back on it anyway. I'm going to get some cash that's going to go into my account, and they can move up. So they can move up very, very quickly. So I'm never going to reach the bottom.
mhm.
However, if I think the fundamentals are positive, the business is decent, its growth prospects are decent, the outlook I think is probably going to improve in 6 months. 12 months, interest rates will definitively start coming down unless our friend across the water decides to come some other idiotic move. But and I can have a great result from these levels. Um, it might sound like a bit of a broken record. I've been calling this for a while, and it hasn't got any better necessarily. But one reaches a point when you think, wow, you've got some terrific, value here and some amazing bargains. And now is the time to be really, really looking carefully at some of these bargains.
Excellent. So to summarize, the AIM market has a large disconnect in terms of the share prices of its constituent parts are often not reflective of the companies themselves and their fundamentals, and that's where the value lies. It's what private equity is looking at, and it's the reason why in the long run you hold your nerve, and those are the companies that end up coming good. So if you're in the market, you sit tight, and if you're not, you get into it and try and enjoy the long-term investment. I suppose that's the way
Yeah,
you might look at it as a
yeah.
professional.
I think returning to that stock example I gave. Well, the Jet2 shares have fallen. So let's do it for a proxy of the market. So is it trading badly? No. Is it losing money? No. Does the future look really terrible for it? No. Are energy prices a concern? Yes, to a degree, but then again, it's hedged. So there are no fundamental reasons why this stock should keep going down, forever be cheap. And much like the market itself, a lot of those elements apply to AIM as a whole. Is AIM a weaker market than it was? Yes, well, there are fewer companies on it, that's for sure, but there's a greater proportion of decent companies. I mean, 20 years ago, there was a heap of rubbish on AIM. Thankfully,
Mm,
we avoided most of those, but there was a lot of rubbish. Now you've got far less rubbish. You know that because everybody, serious investor is trying to buy them.
mm,
So yeah, I think it's in rude health. It's just that the UK buying population doesn't think so, or is he, or is being influenced not to think so, and is being guided to invest elsewhere, which is wrong, I think. You look back at a decade, say our performance was pretty good, but we had so many more failures then.
mm, mm,
Companies that go to, I mean, the era that Patisserie Holdings went bust on us and we lost everything
mm,
literally within a second, within
mm,
1 day, lost the whole stock.
mm,
The portfolios were still up that year.
mm,
Every year prior to that, there was an issue company, it was a material loss maker, or maybe two, but generally portfolios are up. Now we don't we don't have any, touch wood, we haven't seen any basket case total disaster. I think Argentex was the last sort of disappear overnight stock.
mm.
But other than that, well, it wasn't a very big holding, thankfully. But other than that, the risk in the book is probably at its least risky,
Yeah,
at its lowest level
yeah,
ever in our
yeah,
history.
yeah,
But nobody likes it.
yeah.
Do they want more risk?
Yeah,
Perhaps it. Do we need a return for the Wild West?
yeah.
Because in the Wild West we were making more money. People were losing on individual stocks, but yeah, it's bizarre. It's really bizarre.
I'll put your contact details in the description of this podcast. So if anybody wishes to talk to you about the prospect of getting into the AIM market or making additional investment in the AIM market at this time, or indeed remaining in the AIM market, they'll know where to make contact.
Yeah, I think the final sort of snapshot in it is don't think about just the tax planning of it. Look at it now sensibly as for its investment perspective. We seem to have gone past the IHT planning benefits. Sadly,
Mm.
yes, you're getting IHT relief, but look at the investment potential. Look at it properly with the degree of common sense. Are these good investments? Forget about any tax benefit. And to me, they look to be some pretty good investments at the moment. May not be instant, but I think in 3 years' time you'll be smiling.
Excellent. Well, thank you very much for your time today, Chris.
Thanks very much.